jobs number. We got a lot of stuff coming up. There's movement right now on the jobs report. Blake's going to break it down for us. A lot of stuff happening in the market this week. Blake, this is an ambition. We got to try to talk about this stuff in so little time.
It does seem like we get stretched a little bit, and when we do something like today, this is way too many moving parts. I think it's just shocking to see what's happened over the last 3 days and what that could mean for not just today, but the year. I mean, this is a shift.
One of the things Powell articulated in the FOMC policy statement plus his aftermath and his press conference, it looks like we're leaning towards rate cuts. The market's pricing that in. The market's got what it's wanted. So now all of a sudden, does data all of a sudden matter? So we've got a jobs number that came out today. Let me just actually show I'll show Forex Factory so we get a nice little summary here. But we came at an unemployment rate ticking up 0.2 to 4.3%. Average hourly earnings coming in under expectations, and we only added 100,000 jobs 114,000 jobs last month. So Blake, any internals that you're seeing that you want to bring out?
Yeah, I read a number of the things in the report, and it's the biggest loser, if you want to call it that, for this last month was technology. So information systems and technology, and so that's what they just call it, information. That's how backwards the Bureau of Labor and Statistics is. It's information. So 20,000 job layoffs net loss. So whatever they hired, they laid off 20,000 more in that area. And in transportation. So we saw a drop there in transportation and in technology. And should that be a surprise if we see that the rate cuts are finally coming? What's the justification for the rate cuts? Why were they talking rate cuts? We've talked about this because it certainly wasn't inflation. We didn't see it because of inflation. It seems to be that they were seeing the writing on the wall. They had the data before. Yeah. And so looking at these numbers, we're absolutely seeing massive slowdown. In fact, this is the lowest number since February of 2021. There was a lower number, but we've revised it lower multiple months. So last month when we thought we did fine with 206,000 jobs, they revised it to 179. Mm-hmm. And so there's another 25,000 job loss. The previous month to that, they said 272, but they revised it down to 218. And so we keep seeing that they gave us this big number and then brought it down 30,000, big number, brought it down 60,000. And so the numbers weren't anywhere close to what they were inferring. And this month, what if this 114 is actually worse than the 114?
I always love GDP. We got again, I bring this up a lot because it's such a stark contrast. Second quarter 2008, we had 4.1% GDP, and then a year later, lo and behold, we're in recession, right? I mean, that's the issue with a lot of these numbers. And if you're starting to see weakness in the job market, you're entering recession at that point. So again, we're seeing weakness here. The weekly jobs, just the unemployment claims taking up to 249. I mean, that's the highest we've seen for a while, going back to mid 2003. So, I mean, we're seeing the jobs markets starting to soften a little bit. Notice again
don't go past there yet.
Earnings
go down. What? I'm going to play back. Go back to the weekly unemployment claims.
Okay.
For everybody that is unaware, that is new weekly unemployment claims. This is not a cumulative number.
No.
That means additions. That we're building people so this is people that lost their job, had to wait the waiting time period, filed for unemployment claims, and we've constantly been increasing this. This is bad news.
Right. So, I mean, you start to get this 4-week average starting to rise. And again, it's like, does the data now begin to matter if the Fed's going to cut rates? Let's bring up the ES. Let's see the reaction to the market. And Blake, you're trying to make a trade in the midst of all of this.
Yeah,
you're talking about liquidity is a little tough right now.
Yeah, it was very bad liquidity. So I took a short position, and one, the toss charts weren't keeping up. Two, the spreads got crazy wide. So in the futures market, we usually look for 1-6 spreads between the bid and the ask, and we were going 2-3 points spreads and the futures. So there was kind of a no liquidity in that huge handle. We saw the ES drop from 5,400 down to 5,390. That's most days for the ES, and we did that in a matter of seconds. And then the same thing with the Nasdaq. Even it was huger. Anyways, it was just massively down. It was ugly.
So we're seeing a little bit of a drawback in here, retracement off that initial selling, but yeah, the initial reaction was to sell the market, and we may see this roll back over again. We'll see. I mean, is this just a knee jerk reaction? But it's felt pretty broadly. I mean, gold getting a bid, silver getting a bid. The dollar in this case, U.S. dollar. Sorry, we'll get euro U.S. dollar first. The euro slash U.S. dollar. Euro really taking off against the dollar right now. And the dollar yen, a huge bid under the yen after this announcement. So dollars being sold today.
Yeah, well, can I just say that actually makes me more nervous? Not just that the Nasdaq fell. I mean, we were so inflated and so high on the tech sector, but that scares me. That gold spiked as high as it did on a weakening jobs number. How do we have gold up, silver up, and the market's liquidating off of high rising unemployment without it being that nasty word stagflation?
Yeah, and that's the thing is when you see gold leading the S&P, again, that's historically ties into a weak dollar, intrinsically weak dollar, and again, it's more of a stagflationary scenario. So the S may be starting to roll over after that initial sell off, and we're getting a slight rally here. But again, I do think we're going to start to see data matter more because we're getting the rate cuts. We know that. Now it's a matter of saying, okay, are they cutting because of it? They're a mission accomplished on inflation, or is this really about overall economic weakness? And as we think about some companies that are announcing or have announced, Apple and Amazon, Apple's basically slightly lower following their announcement. Amazon a bit more lower. We're about down close to what? That's almost 10%. Is that 10%? Yeah, 10% overnight. Is that 10%? Like suddenly questioning my math, but that's 18 points, right?
Yep.
So that's a big move in Amazon. If we look at the expected move for yesterday, it was about $9, and we are currently down about 18. Look, I mean, we're punishing companies that miss a little bit, but the guidance is one of the biggest things of factoring into these companies. Microsoft this past week was pretty weak in terms of the reaction there. Meta obviously got the boost, but faded yesterday. So those are the big four companies announcing this week. So far, not so good.
Yeah, it's miserable. And I was looking back at the data that we talked about yesterday, and remember that the inflation numbers that are justifying the expectations of a rate cut are being driven primarily because we didn't increase wages. Wages are up 0.9% year over year.
Yeah.
And GDP up, what did we finish at? 2.6, 2.7? 2.7. I'm confusing PCE with GDP here. One's 2.9, one's 2.7, if I remember. But even then, if you've only saw wage increases by 0.9%, while GDP and PCE inflation numbers are showing 2.6, 2.9%, then that tells us that we're seeing growth in inflation at 3+ times the rate of wage increase.
Yeah.
That is stagflation.
And that's what the Feds wanted.
Yeah. They want stagflation.
Well, don't they? I mean, look, they've not really reduced the size of their balance sheet materially, right?
But they're going to keep doing it
forever to take down their programs. And the only thing they're talking about on the inflation front is killing job growth. They're killing wage growth. So it's like, I mean, it seems to me this is exactly what they wanted. They want to get to ZERP. They want weakness to some degree. They don't want us to fall off a cliff. But we're looking at the VIX kind of popping up here to 21. A question, UK Ray talking about, is this an indication? Are we in backwardation? We're close. I mean, we have a very, very flat VIX curve right now. You see a little bump here from Sep to October. I mean, if you dig in and get to the minutia of the VIX futures, basically when you have falling prices. So if we're following here, going to the active down here to the next and the next, a little bit of inversion right here. I like looking at the monthlies mostly, but yeah, I mean, it's a pretty flat VIX curve right now. Now, here's the question: is this a normal sell-off? A normal sell-off being, 5% ish, maybe upwards of 10%, or is this a bigger pullback that we're about to experience here? So if we're talking about the latter, a bigger correction, 10, 20%, the backwardation probably isn't going to save you, but it's something to watch. I mean, if we can get a big enough push in the VIX, we see enough of a sell-off, maybe we can get there. I mean, something to look for is a high percentage of stocks that are down today. You get a 90% down day today, meaning what? Dollar sign DCN plus dollar sign ADVN. We're looking declining versus advancing issues, and you can bring up a pairs ratio study. And if this value gets up here like 910, you might be getting there. A spike in the VIX. So again, we're seeing 9 to 10 more down stocks than up stocks. We'll have to see. We really haven't had that washout kind of day with massive just correlated selling. And yesterday was a good day for utilities. I don't know. What do you think, Blake?
Well, these are my sweet spots. And by the way, they're saying that my sound is garbled. Am I coming in
There's a
garbled to
little
you
bit of a jumble every now and again.
every now and then? All right. Well, I just muted and unmuted and tried to reset it there. So let me know if it does it again. I'll try something else. But I've been talking about this for literally a month. XLU, XLP, XLV, healthcare, consumer staples, utilities, healthcare, consumer staples, utilities, over and over and over again. These are the defensive sectors. This is where we need to be. It is the only safe place in a market that's correcting.
Yeah.
And they might still dip, but just not as far.
Yeah. And that's the thing is, I mean, so for example, I have a SPY plus XLU. What this does, it takes a ratio of performance, relative strength line of S&P and utilities. And this was something, it was won the Dow Award for the Market Technical Association years ago. But they just took on a 4-week rate of change basis, whether utilities or S&Ps outperforming, and you buy the one that's outperforming over a 4-week period. Unfortunately, we can't do, that's why we're doing this pairs ratio. We can't do mathematical stuff like divide. But anyway, but you look last Friday. So I talked to this last Friday during my session. Here's last Friday's value on the relative strength. Go back 4 weeks. 1, 2, 3, 4. Last Friday, we saw a rotation away from the S&P on a 4-week rate of change basis towards utilities. And so that was the signal to sell the S&P, buy XLU. If you're doing that kind of binary approach, the last time this happened was back here on March 4th, right about right here on a 4-week rate of change basis. Why's the dates changing here? But anyway, back around March, we saw the rotation. This is off. What's going on here? Oh, I'm on a weekly. That's why. On March 4th, I'm like, this doesn't look right. Wrong year. Right here on March 4th. And we saw over the next 3 months, we saw as the yellow lines declining, utilities outperforming the S&P 500. We got an indication here, June 3rd, to sell XLU, buy SPY. And now we've got the signal to sell SPY, buy XLU. And again, so that was a very defensive signal we got last Friday based on the performance of S&P and XLU. Again, XLU now performing. So we had some big breakouts this week in utilities. Southern, huge move. Mm-hmm. This is the one I tend to default to, but it's so high. I put Nextera on my list, and you put Nextera on your list. What's your target right now on Nextera, Blake?
Well, obviously, just one retest that previous high. I'm looking at this as potentially duplicating this as a new revised cup and handle-ish type size. So we could be going another $10 to $12 higher. So I'm looking for 90, maybe 100, but I'm just going to say 90. I'm not even sure we'll go 93 yet, but 90, there's some overhead pressure up there at 90.
So this is it's a $10 range. So if we test, break, 80 to 90 would be $90 would be the target based on a cup and handle. A cup and handle is a bullish continuation pattern, which of course this would be if we break through the highs here. So yeah, I like that. Again, it's a matter of when we're in this position, right? If we are in a lower growth uh outlook, right? I mean, you tend to see rotation to staples, utilities. You also will tend to see potentially if we're in the latter stages of that growth trend and tipping into the other, energy materials can do well. But with the stronger dollar, and let's just take a look at what oil's doing right now, forward/CL. Um, oil looks like it's getting sold on the news. We look right here at 630. Again, this is the question: is the selling in energy about overall economic weakness, in which case energy shares probably don't do well, or is this just about kind of just a temporary selling, in which case oil should pick up? When we look at the product depth here for CL, it's still in backwardation. It's flattened just a little bit from prior weeks, but still, I mean, we have a lot of geopolitical risk. So again, I'm still kind of hanging on as far as bulls and bears here to some energy names. Schlumberger is more about increased production, but we'll see. I mean, this is a real question of whether or not this is really about economic weakness. We're going to see a more of a sell-off in energy. So it's very possible. So Blake and our opposite ends on energy. I'm nervous, but I'm still optimistic. But again, if the dollar's going to strengthen, we're going to see economic weakness right around the corner, or we are experiencing it, then energy will fall.
Yeah, well, and I would also say that with energy, you'd also be looking for, if it does fall, the utilities will only go faster.
Right.
So it's going to be a complementary inverse relationship. I'm going to look for that to continue to be a complementary inverse relationship.
Yeah,
And the cruise has been what's driving it for me.
So let's quickly talk about just earnings this past week. I mean, Amazon. Again, we sort of kind of looked at the intraday chart on these names. Amazon's down big, Apple's flattish. We saw earlier weakness in Microsoft this week. So a little summary on the earnings front. We have about close to 70% of companies announcing. We've actually had very solid earnings growth, up 11.7%, 80% beating on earnings. On the revenue side, it's a little bit of a more of a negative tail, 5.1% revenue growth, only 60% beating. So we didn't quite get the negative revisions coming into this quarter we've had in previous quarters. A little bit harder to hurdle on the revenue front. But the biggest issue is stocks like Google, companies like Microsoft, and this is where the AI boom led to huge growth in these stocks, because we say AI. Now we're dealing with we're trying to look at, okay, we've seen big bumps in CapEx spending. Is AI going to yield profits, and profits to a level that justifies the level of CapEx spending? And that's really the wrinkle right now that's affecting some of these companies. It's definitely affecting companies like Nvidia. It's like now we're starting to get worried about, is AI even a viable source of future revenue to the extent that they're investing in it? And of course, that's negative for Nvidia. Nvidia had a nice outside candle despite the positive upgrade in Nvidia the prior day.
Yeah, I think one of my favorites to short here is going to be confirmation, like you talked about yesterday with chips, right? So SMH, I think that's going to be one of your confirmations as far as whether it's going to keep on doing it. Is if the SMH breaks to the low, it's going to be your earliest indicator of liquidation. Yeah. Am I sound any better? I just shut off.
It's the same.
Okay, I'm going to do one more reset here.
I mean, you look at right now in SMH, we're testing a 61% retracement. You start to break this level. Let's just go break through yesterday's low, close below it. We already closed below a low on the 25th, I guess, too, but it looks like we want to go to 200. And look, I mean, this is not going to be popular, but this is histrionics with regards to Nvidia. When Nvidia breaks, it gives back 2/3 of its bullish trend, which is $60. We may see a $60 handle on Nvidia if the scrutiny over AI, actual productivity of AI, given the CapEx spending, it really starts to get there. If we start to see technology sour, and that's what we saw yesterday. We saw the flip. Technology was bid on Wednesday. It was sold heavily on Thursday. We really saw that stagflationary rotation or deflation rotation as gold was sold off. Today's jobs numbers helping gold out just a little bit. We'll see if that can continue, but we're definitely not on that reflation type trajectory right now that should benefit financials. Should benefit technology, I guess financials as well. But if we look at the week, energy, technologies, S&Ps here, financials sold off hard yesterday. We're starting to see a little bit of weakness enter there after the big boost leading into the cuts. So again, I think we're still going to see as we're looking at this. My areas of bearishness are really interest rate sensitive stuff, like, for example, HYG, real estate, home builders, jets still because of the economy side of it. Still think energy is going to hold up here. But materials is an area I'm starting to turn on. We walked through a trade yesterday, more bearish on like Alcoa, FCX, those kind of companies.
Yeah, and jets, where's the lab transportation? So I think transportation and tech, they're being laid off. We're seeing the data already hit the employees, which means more downside.
I really thought interesting yesterday that there was a huge bid under bonds. If you look at FVX, for example, CGI, with huge drop in yields the last couple of days here. Again, for really looking at rate cuts right around the corner, maybe significant rate cuts. And yet, if you look at HYG, high yield credit was sold. We have very, very tight spreads between corporate and treasuries. And yesterday was a big break. Finally, it's been a while where we're seeing that risk spread start to widen out. And this is also, again, should help drag down real estate that has not seen any selling yet. We'll see where it moves today, maybe indicating slightly lower based on the we got some REIT earnings next week, but REITs look like they're going to experience a little bit of pressure this morning. So I think IYR home builders saw weakness yesterday despite the significant drop in bond yields. So again, this is the stuff where you're starting to see correlations break. And so again, I'm still keeping these on the list here. But anyway, URA, so uranium, huge production, expected increase in Kazakhstan, which is the largest producer of uranium. It's pressuring the uranium market right now. So this is a form of energy. But URA had big drop yesterday. Again, recent weakness, but again, increased production should lower uranium prices potentially, and that's going to hurt producers.
Yeah, that downside out on there, another 10% potentially.
Yeah, absolutely.
So I won't spend a lot of time on my stuff. PG, I've already talked to all of this in yesterday's video, so I will push that back. Go watch yesterday's video, especially if my sound's garbled. I've reset, turned it off, turned it back on. Have I tried turning it off and on it again? IT Crowd, great TV show. But as far as that goes, go watch the video on. I talk about utilities, consumer staples, and healthcare yet again. Abbott Labs and TMO have some upside potential as well. But let's get to yours. I mean, we've got 10 minutes, 11 minutes, unless you have some other parting shots that you want to make sure we get to. If you have symbols or stocks you want to talk about or trading things that you're concerned about, economics, let us know. Put it in the chat. I'm trying to watch all three sources on the chat, and let's get through yours as quickly as we can, in as many as we can, better said, in the next, we've got about 10 minutes. So
the question was, from for I Milnes, is this a break? Yeah, I mean, I would consider this a break. We got to finish here. But this is the 1/3 retracement of the bullish trend. This is the seed wave right here. So I'm going to click on the end, go back to the beginning. We're going to draw a projection. If we're looking at what would be typical, if this is the seed wave, we get the bounce, we get the breakdown, kind of a flag breakout here. 250 might be very well in sight here. We'll see. I mean, you got the 138 around 53.19, but if we finish down today, we could very well look at 52.50. We break that level, 5,000. So again, all of this run recently was based on what? Fed rate cuts. We got the rate cuts, or we're about to get the rate cuts, right? It's getting priced in further as we're seeing the buying in treasury bonds. And so again, are we going to buy the rumor, sell the news? 5,000 seemed like could be a pretty reasonable level. We do have support around 53.50, which is about that 138% retracement, 138% projection area, but 261 is down here, 5,000. So Again, I think near term 53.20, break that. We're looking at 52.50, break that. Then we're looking at 5,000. So we got a couple here. Crowd, Elf, CRWD. Do you touch Crowd yet? Oh man,
No,
that's tough. I'm not sure we know where the end of this move is coming. There is potential litigation. I mean, they're saying that the airline stocks, Delta, denied help from them to help solve the problems. There's the issues with Microsoft that maybe even still persistent. So yeah, this is a tough one. I mean, someone had mentioned they'd sold in one of the sessions here that sold put on it. This is one you probably don't want to touch at the moment. It's a tough one. Elf, this kind of feeds into Blake's, consumer staples. It's a cosmetic and skincare company. But the negatives here, we got earnings coming up. Wait for the earnings. If they beat, they raise, and the stock goes up, then think about buying it. Look at 220 being a target. Your thoughts, Blake? Or
no, I agree. Don't touch Crowd and then Elf. I think yesterday's shadow is going to push it down. I would be careful going to earnings there, but maybe buy the bounce at 155, 160. But I need to see it. It needs to stop falling. Yeah. I don't catch falling knives. Let it stop falling.
And with earnings coming up, we don't know. It's a binary event, up or down. We don't know. VXX. These are tough ones, right? I'm like, do you touch VXX? You probably should have touched already.
Yeah.
But this is one you probably don't want to consider shorting at this point. VXX is more about contango markets in the VIX. We don't have that. The contango market's going to drive VXX down as it rolls that near-term VIX futures option or VIX futures contract. So we may go higher, but at the end of the day, we got to see the VIX peak, and this is kind of a natural one to short. But hard to probably get long at this stage. I mean, it's hard to go long volatility after it's broken out, right? So yeah. that's the, and this isn't a
I would not be predicting 60. I would not be chasing 50 to 60 on the VIX move. That's a very expensive cost and very wide swinging move. Exactly. Yeah, CRM, I'm not sure what you mean by BRICS currency other than the idea that the dollar could be sold off. There's no such thing as a BRICS currency. Yeah. Brazil has its own currency. Russia has its own currency. I
kind of use the Aussie as a proxy for emerging markets. It's about as good as you can get on the TOS charts here, probably. And let me know if I'm wrong there. But they're very closely tied to China, which a lot of the BRICS are. China's part of it, right?
Yep.
So a little strength here, but yeah, I think if we're talking about economic weakness, I think this is a pause that refreshes the downside for a lot of emerging market countries. What do you think, Blake?
Yeah, I think it's throw the ASEAN up there. That's my favorite one for everything. It's the global fear and greed index for me, and it's really close to the US. And with this shift, and someone brought this up earlier, the Japanese yen, Bank of Japan moving off 0% has destroyed the debt market, which means we're not going to be able to borrow at 0% and just fund our spending forever. So ASEAN going back here, I still think we're probably going to 94 before we slow down, but
yeah. So I'll draw a quick kind of retracement here. Again, we're at about almost 2/3 of the bull kind of run here. But yeah.
So if it breaks there, 90, I had 94 on my radar, but if it breaks 94, we really could go all the way down again and hit 85, 86.
Yeah, I mean, again, this is a carry trade kind of unwind right now. And where does the depths go? I mean, if this market continues to weaken, we see underperformance and investments, foreign investments, that money's going to tend to repatriate back to yen. And again, that's going to continue to strengthen the yen. And so be careful. I mean, this is the biggest breakout that we've had in the yen, ASEAN, and how long, Blake? I mean, let's look at a monthly move here. We'd have to go back to 2007. I mean, that size of July's candle. I mean, maybe a little bit here in 2012, 2020 and we had a range that was that big. We didn't finish there in 2000. in 2020, but this is the biggest monthly sell-off we've had in the yen for really going back to financial crisis. And it's
Yeah.
at the same level as the yen was against the Aussie as the financial crisis in 2007. All right, what else we got here? KRE or Bitcoin. So is Bitcoin going to get lifted today? I mean, Bitcoin hasn't always really correlated with gold per se.
It's
It's
a
often
risk
that's
on
been more
asset.
correlated to technology or more high beta that's holding up here. But do you think Bitcoin has a chance if gold rallies here, Blake?
No, no, to zero. No, it's a risk on asset. And so just because you're a little nervous with the US dollar, just because you think inflation's there, unless you're willing to push risk higher, which we're not with all the selling, Bitcoin is not going to go up and hit 70,000. I just don't see it.
And it's hard. You look at Mara, big breakdown yesterday. I mean, it didn't get any favor. I mean, earnings came out as well. Earnings are going to be bad for a company like this anyway. But this is a short squeeze type company, right? A lot of these names in this space, it's about high short interest, and we get a little bit of bullishness. We get the squeeze, they go higher. This is not a phase right now. It looks like that we're going to see a lot of rotation to the high beta momentum type names, or we're working away from those names. And currently, so KRE, look, I mean, I've been talking about when are financials going to break. KRE again sold off yesterday with a massive rally in bonds. So they have all these unrealized losses, and yet the industry rather, sold off pretty dang hard. Again, we got the run based on rate cuts. We even saw the spread between like a 5 and 10, 5 and 30 actually improve for these companies, become more positive in terms of 5 and 30, and yet they sold off. And so it's been a real issue in terms of margins, the inverted yield curve. But again, if we're about to start to revert to long-term treasuries to get above short-term treasuries, the borrow short, lend long should work and help these companies, unless we're really talking about a default stage of this economy of their portfolios really starting to pick up. And that's the real question. We'll see what happens. Blake, you mentioned on Wednesday about current default rate for home loans being relatively low. We're starting to pick up on the credit card
credit
side.
cards super high. Yep.
So
Credit
again,
cards are
this is
13-year highs right now. So
and yet, I mean, companies like PayPal, for example, I mean, they've held up. Square, it's gonna get a little it's flat after its earnings here. Capital One Financial saw a big downturn yesterday. So again, I think there's opportunities. Names PayPal just ended up after initially selling off, and then they just popped on the earnings. But this might be a decent short opportunity in PayPal up here too. But again, I do think consumer financial names are going to struggle. And again, we're going to see home builders again totally diverge from interest rates yesterday as yields were dropping. Also, home builders were dropping. Again, borrowing costs should go down. If you don't have money to borrow, if you don't have a job, if you don't have disposable income, that's a problem.
yeah, and that's what I've been bagging on regional banks for weeks now, and so it worked out really well for me. I would say one of the other symbols. Do you chase bonds higher?
What was the symbol again?
Oh, TLT. Do
Oh,
you chase
TLT. Yeah.
bonds higher? Yeah.
Yeah. And what we saw yesterday, though, we saw that shorter term yields drop faster or further than longer term yields. But if the Fed is on the cusp of a major rate cutting campaign, I mean, again, this is the distinction, right? But let's go back to monthly here. If we're on the cusp of the Fed going back to ZERP, if the economy is going to go off the cliff, it probably doesn't have to go off a whole lot for the Fed to go to ZERP. We may be talking about massive rallies in bonds. And this is one of those things that, I mean, you can take a stab out there. You can say, look, let's go out a year. Let's go Jan of 26. Now we got a year plus. Let's see what kind of strike selection we have. But notice rising call volatility. You can get out here and buy a really cheap spread and just bet on the Fed's going to ZERP at some point in the next year and a half, or a little year and 3 and 4 months. So again, you can do stuff like this, and it's pretty cheap to do. Not a very highly probable trade, but you got a 20-point spread here. It costs you $1.86. So if you're willing to throw away $1.86 or $186 for potentially hauling in, 18, 19 or 18 plus dollars, if we're north of 130, and if we go back to the charts here, I mean, 130 is right here. So
you can hardly go to dinner for that cost.
You what?
You can hardly go out to dinner for that cost.
I know, right? So take the next dinner at Blake's favorite restaurant and you throw it in here. If the Fed cuts it to 2%, we're probably north of 130 by January of 2026. So there's ways to kind of play this with very little risk. But if the Fed's going to start to cut rates, I've been talking about shy, and I think Johnny's kind of been talking about as well, going short term, and there might be some room for appreciation here. So we got to wrap this up.
Yeah.
So
well, join us
Don's
again
about
next
to come
week.
on.
And for those of you who'll see in the main room later on today, but have a great weekend, everybody. Brandon, thanks. Thanks for, sorry, my sound's ugly. I've shut it off and turned it back on 3 times. So I'll have to reset the whole machine and see if I can fix it. So
it only makes me look better. So that whatever it takes.
That's not hard to do. You look awesome. Thanks, everybody. Have a great day.
See everyone.